We hear so much about, lightning fast innovation in tech, but what happens when that same energy hits, well, the much more cautious world of big finance?
Yeah, it's not always a smooth ride. Even giants like JPMorgan Chase can run into some pretty interesting problems
Yeah.
trying to speed things up.
Exactly. And that's really what we're digging into today, based on this cognitive market research piece by Sonali Shinde. It's called JPMorgan Chase's Fail Fast Philosophy: How Risk-Taking in Innovation Backfired.
It's a great case study, really. A major player tackling a very modern kind of challenge.
Right. It's not just about small bumps in the road. JP Morgan really went for this fail fast idea, the whole Silicon Valley mantra.
They dove right in.
So in this deep dive, we want to unpack why they did that, where things kind of went wrong in that specific banking context, and what lessons, we can all take away, especially for big established companies trying to innovate.
It's that classic tension, isn't it? Trying to be agile versus needing to be rock solid stable, which is what you expect from a bank.
Totally. So why did they embrace this? What was the big push?
Well, the article makes it clear it was about survival, really. Digital transformation. They saw these nimble tech firms moving in and knew they had to change. To compete, banking had to become digital first.
And they put serious money behind it, didn't they? Jamie Dimon, billions into tech.
Oh yeah, huge investments. And the appeal of fail fast was, well, obvious in a way. They hoped it would create this, like, more innovative culture, less fear of failure, right? Empower teams to just try things, test them quickly.
Get ideas out there faster.
Exactly. And it wasn't just, one little corner of the bank. They pushed this in product development teams, these internal incubators, trying to act like startups. And even in specialized units like Onyx, which was looking into blockchain and digital currencies. Pretty broad application.
And I mean, it sounds like there was some initial success. The article mentions good things happening early on.
Yeah, definitely some positive momentum. Yeah. Better mobile banking, using data analytics in more sophisticated ways, getting into corporate blockchain relatively early.
So the core idea seemed sound. That rapid testing, quick learning was the way forward.
That was the belief, absolutely. In a world where tech changes constantly, being able to experiment, learn from mistakes, and adapt quickly, well, they saw that as strategically vital. Not just nice to have, but essential.
Okay, so the motivation was strong, the investment was there. Where did the cracks start to show? What were the big hurdles for this fail-fast approach at JP Morgan?
Right. This is where, the theory hits the reality of a massive regulated institution. The article points out the culture shift just wasn't even.
How so?
The tech folks, they got it. They embraced fail fast. But the more traditional parts of the bank, the ones used to strict rules and managing risk carefully, they struggled.
Different mindsets.
Totally. And that led to real friction. Disagreements on priorities, where resources should go, even basic stuff like who owns the risk if an experiment goes south.
You had this, startup speed bumping up against the bank's need for caution and process.
Exactly. And that leads to the biggest roadblock, really. Regulation. The banking world is just so heavily regulated.
Yeah, you can't just move fast and break things when you're dealing with people's money and, global financial stability.
Precisely. Yeah. For a typical startup, a failed product might mean lost investment. Annoying, but okay. In banking, failing fast could mean breaking serious rules.
Regulatory violations, huge
A
fine.
massive scrutiny and losing customer trust. That's catastrophic in finance. Think about all the rules, anti-money laundering, consumer protection, capital rules.
You can't just iterate your way out of violating those.
No way. A fast failure in product development could easily trip wires with massive consequences. It's not like tweaking a social media app.
And the article gives a big example of this, right? Fin.
Ah, Fin, yes. They're a mobile-only bank aimed at younger people. They put a lot into it, launched it nationwide in 2018.
And then pulled the plug just a year later in 2019. That's fast.
It really is. Yeah. And that's what's so revealing. All that investment, the public launch, and then such a quick shutdown. It showed how risky applying that rapid model is when customer trust and the brand are on the line.
Failures are very public.
Extremely public in finance. The article's fast fact really drives home the cost and the questions it raised, both inside and outside the bank.
Yeah.
It just didn't get the traction they hoped for.
And it wasn't just Fin, was it? The article hints at other projects, too.
Yeah, I mentioned some blockchain and AI initiatives that, despite getting significant resources, didn't really deliver scalable commercial value.
So a pattern started emerging.
You could say that.
Oh.
And naturally, that attracted attention. Regulators started looking closer. Shareholders began asking harder questions about, the oversight. Is this innovation spending actually working?
So the core problem kept coming back to that fundamental clash, yeah. The freewheeling startup vibe versus the realities and responsibilities of being a huge, systemically important bank.
That's the heart of it, according to the analysis.
So, okay, these project failures had obvious costs. But what about the ripple effects? How did this impact things internally day to day and how stakeholders saw them?
Oh, big time. Internally, you had teams used to structured long-term work, suddenly dealing with constant prototyping, quick pivots, projects getting canceled. It was disruptive.
I can imagine.
The article talks about teams getting pulled off one fail-fast thing and thrown onto another, sometimes without much clarity. That leads to frustration, right? Feeling like your work is wasted. It hits morale.
Yeah, definitely sounds inefficient and demoralizing. And the article mentions something about a lack of clear exit strategies or like proper postmortems.
Exactly, which can give the impression that maybe the innovation was a bit scattered, maybe driven more by hype than a clear long-term plan.
So that's the internal picture. What
Yeah.
about outside the bank? Investors, clients?
Well, externally, that initial praise for being ambitious started to shift. Investors and analysts began looking harder at the ROI. Billions spent on tech. What are the actual tangible results?
More scrutiny on the spending.
Yep. And then you have clients, especially the big corporate and institutional ones. They value stability, reliability above almost everything else.
They started getting nervous about these new tech tools, wondering if they'd be supported long term.
That's the concern highlighted.
Yeah.
In finance, trust is everything. Even just the perception of constant change or instability can damage those critical client relationships.
It sounds like a really tricky balancing act, trying to be seen as this cutting-edge innovator.
While also reassuring everyone you're still the same super dependable, stable bank they rely on. It's walking a tightrope.
Okay, so looking back at JP Morgan's experience here, what are the big lessons? What should other large organizations, maybe even outside finance, take away from this if they're thinking about adopting similar fast-paced innovation?
The article draws some really clear conclusions. The big one is balance. You need to balance those agile, experimental ideas with really strong governance and risk controls.
And those controls can't just be generic, right? They need to be tailored.
Absolutely. Tailored specifically for the scale, the regulations, the specific risks of that large institution. You can't just copy-paste the startup playbook. It needs serious adaptation.
Makes sense. It's not just about speed then. Innovation needs a clear why.
Right. The article stresses it should be tied to real business goals. And success shouldn't just be speed, but things like, is it sustainable? Does it meet compliance? Does it actually help customers?
Otherwise, you just end up with fragmented results, maybe, if you just mimic startup tactics without thinking about your own context.
That's the risk. And another key point is integration. Innovation can't just live in the tech department.
It needs buy-in from everyone. Operations, compliance, the business side.
Yes, exactly. That cross-functional teamwork is crucial. It helps spot risks early and make sure new ideas actually fit the overall strategy, not just tech for tech's sake.
And knowing when to pull the plug is as important as knowing when to push forward.
Definitely. The article emphasizes defining what success and failure look like up front. That gives you a clear basis for deciding whether to keep going, pivot, or stop.
And finally, transparency seems key.
Hugely important. Being open about both the wins and the lessons from failures with your own people and with the outside world that builds trust. It shows a mature approach to this whole digital transformation thing.
So it's not that JP Morgan isn't still a leader in tech.
Oh, they absolutely are. But their experience here is, like the article says, a really powerful reminder. A cautionary tale, maybe. Innovation in finance needs that boldness, sure, but it also needs serious caution and a deep understanding of the responsibilities involved.
Okay, so just to recap, we looked at JP Morgan's big push into the fail fast world, driven by the need for digital transformation, wanting that startup agility. But it ran into major hurdles: the regulatory environment, the cultural clashes inside a huge bank, the high stakes of failure in finance.
Yeah, the Finn example really highlighted that.
Right. And the lessons learned are really about finding that careful balance, agility with strong governance, innovation tied to real business needs, integrating it across the organization, and being transparent.
It's about adapting principles, not just copying them blindly.
So that brings us to a question for you, our listener. Thinking about the complexities JP Morgan faced, What do you see as the single biggest hurdle for big established companies trying to get more agile, more experimental? And maybe how could they start to overcome that specific challenge? It's relevant way beyond just banking, isn't it?
It really is something many industries are grappling with.
Absolutely. And if this deep dive got you thinking, maybe you want to look more into innovation management or the specifics of risk and finance, or even dig into some of those cases like Finn.
There's a lot more depth there, for
Yep.
sure.
The way companies innovate is constantly changing, and understanding these kinds of experiences is crucial as that evolution continues.